If the market does not set a daily higher low, the rally will fail. If semiconductors cannot stay over the range high, the rally will fail. If small caps cannot stay over the weekly pivot, the rally will fail. Do you see where I'm going with this? Things are changing out there, but now it's all about getting follow through. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and first and foremost, what's going on here with the daily trend, because there's been a pretty dramatic change. Of course, from here to up here, today's session, and even on Tuesday's open, we instantly had the gap up, giving us a higher high on the daily time frame chart, meaning that the daily trend is no longer down, right? Before that, we had been counting that we had highs, lower highs, lower highs. This was an equal high as of Friday's close, but of course this was a downtrend, right? We had lows, lower lows, equal lows, and lower lows here. So that trend is officially over. And again, kudos to anybody who is using the resistance trend line. The break of that on Friday of last week certainly signaled the end. But even on Tuesday, Monday was a holiday, on the Tuesday gap up, that was enough to bring in a higher high in the daily trend count. So now we're dealing with the beginning stages of an uptrend. Now, of course, as mentioned in the introduction, it's absolutely critical that the buyers are able to produce some sort of higher low here to preserve this uptrend and keep it moving in the upward direction. Of course, any continuation just up and over and into blue sky territories speaks for itself, and a quick comparison that we might make here is the lockout rally we got after the monthly higher low that was set way back here in October of 2023, right? You can see off of these lows, it was gap and go, gap and go, gap and go. There was no big pullback on the daily time frame chart. And I don't know about you, but it's starting to feel very similar to what we're dealing with off of the lows from over here, where it's gap and go, gap and go, gap and go. There may not be a pullback. There might just be consolidation up here. Maybe there's one gap fill reversal that keeps price over 603, which would be ideal, keeping this previous overhead supply no longer acting as overhead supply, right? If we can stay above 603, then anybody who's still holding long from that position, which again, bless them, because of course you had to sit through some drawdown here, but regardless, if you're over 603, that's no longer as big of a threat, right? If there was an ideal place for the sellers to try to produce some sort of fight, some sort of battle, move price in the downward direction, it should have been on the retest of 603. Right? Previous support acts as resistance, should have acted as resistance again if we had stronger sellers in the market, which at this point, based on the multiple gap and goes, 1 CPI, 2 that Friday of last week, and of course this headed into this morning's session, there's no stronger sellers here. If we had stronger sellers, these gaps would be closing. If we had stronger sellers, we would have opened inside of range on the, again, Tuesday session, getting those days mixed up, and we would have attempted to see a breakdown underneath the inverted hammer low. The whole point of the upper wick is that it was very possible that sellers stepped up into the end of the day on Friday afternoon. That simply did not hold true via the gap up on Tuesday. So yes, one of the gaps has closed, but generally speaking, on the bar to bar count, one thing that you'll notice here is that we have one time framing in effect in the upward direction, where every single daily bar is able to produce a higher low. So would I try to short the market if we're still continuing to put in daily bar-to-bar higher lows? Absolutely not. There's no reason to be shorting the market up here. Now, yes, from a structural perspective, we did indeed produce an inverted hammer on today's session. It's very possible that towards the upper edge of the weekly expected move, we start to see a little bit of a pullback. But once again, if we were to take out today's low, there's a structural trade that unfolds as a short, but we don't overstay our welcome. There's a gap close into 603, and then everything we've just discussed about the importance of staying over 603 steps up, gap fill reversal. Do we see buyers step in here? And if so, there's your daily higher low. And if we can produce a daily higher low, then the rally will continue in the upward direction, and it will not fail, as we have made note in the intro. There's a couple of other levels that would sustain a daily higher low, and I hate to be that guy, but we can get crazy with it, right? If this is the last low, this is the lowest low in the trend cycle right now, where is a higher low produced? Hate to be that guy, but you could come in here and you could close the CPI gap down at 584.75, and what would you have on your hands? right? Technically from here to here, that is a higher low. Now, do we want to see that? Is that an ideal outcome? Absolutely not. From a trend perspective, getting out of this box finally, the best outcome is just a higher low that's produced over 603 back to the all-time high, looking for blue sky territories. Beyond that, I might give the buyers another shot. Not might, I will absolutely give the buyers another shot here. What I meant to say is I might say that the sellers have something happening if we're under 603. They have maybe a little bit better of an edge versus being over the top of Tuesday's high. But generally speaking, this will then turn into the next idea. Can we get support over previous resistance, acting as new support? New buyers stepping up at 599.65. Can we set a daily higher low off of this level? So the name of the game out of this market right now is absolutely conceding the point. We have broken the resistance trend line, right? That is a no-brainer. We're outside of this box. We are getting price acceptance up here as of today's session only on the Wednesday, right? Inverted hammer, yes. Upper wick, yes. And as we'll see on the market internals in just a moment, it really wasn't the best display of strength today. But if we do get a higher low over 603, we rock and roll. If we get a higher low down here, somewhere around 599.65, we rock and roll as well. And the opportunities for entries here are possibly if you can get the Brigade bolt back over 599.65 for a higher low double bottom. You could call it an inverted head and shoulders if the left shoulder builds out. You could also have a re-entry opportunity up here on the higher low back over 603 if we get it. Now, of course, what do the sellers want to see, right? The sellers want to see some kind of opportunity here to get back down into the box. And this is where we have to be careful about our time frame of analysis matching our time frame of execution. If you're a day trader, if you're a scalper, I would typically say that the short-term trend here, of course, is absolutely back in the upward direction, and therefore it makes the most sense to be looking for risk-reward opportunities back in the upward direction as we've just described. However, if you are someone with a swing trade mentality, and if you are just, I was going to say rotten to the core, but let's not call bears rotten to the core. If you are a short seller to the core, and you want to see what we would classically refer to as a look above and fail, like this. If you can spot a lower high underneath 603, and if you want to take the attempt at risk reward along these lines to rotate all the way back down to the bottom end of the balance, heck, maybe not even all the way down to the bottom end of the balance. Maybe you're just looking for something like this to come in here and close the CPI gap. Is that wrong from a risk reward perspective? Not really, but it is certainly counter trend to the aggressive activity, the buy side activity we've seen over the past couple of trading sessions, primarily denoted by the three glaring unfilled gaps that we have underneath us. We have recaptured the daily 50 SMA. The trend count is flipping to up with the opportunity for a higher low. We, of course, have the higher high, so I would say that the shorts really don't have that edge, right? So that's my primary take from the daily perspective. Higher lows are the name of the game. They really have been as soon as the gap up on Tuesday morning happened, and you would have known that if you've been tuning into the pre-market preps, right? On Tuesday morning, we said, hey, gap fill reversal in the ES futures, right? The level was 60.50. If we hold up over 60.50, it's rock and roll. We're looking for upside, and that's kind of exactly what happened into that afternoon rally. Before we take a look at the market internals, I do want to drop down to the hourly time frame chart here to get a little bit more granular and just point out, again, from a pattern perspective, inverted head and shoulders has kicked this off, CPI gap up. No attempt from the sellers to close that gap in a more aggressive way. Same thing happening here on the Friday gap up. And today, very minimal activity off of the open to just hardly look underneath the opening print, peeked into the gap, said, you know what, not today, no strong sellers, and we were off to the races for a morning rally in the upward direction. Amazon has really been the cream of the crop over the last couple of trading sessions, and we'll get to that. But for the most part, once again, you can see these levels as clear as day. I'm very interested in hourly reversals here, something that looks like this. I want to execute on this white dot and this white dot for higher low pullbacks. If we get a little bit further than that, right, maybe if you want to push your luck, you could try a short from, let's say, point A to point B. I really don't think that's a lucrative opportunity. I would not get hung up on that trade outcome. I would more so be interested in saying, okay, we pull back, whatever, we get down to this level, show me the love off of the inverted head and shoulders or whatever, and then we're trading back in the upward direction like this, executing on this white dot and this white dot over here, right? So 599.65, 603 really don't change from that pattern perspective. Where would we start to have slightly more concerns about the hourly trend potentially creating a very severe lower low? Probably if we were to take out with meaningful acceptance 599.65. And again, this is an hourly analysis, right? This is not a daily analysis. This is not a weekly analysis. This is not calling for a market crash. But if we were to see a movement underneath the low of the Tuesday session, what that primarily stops is the one time framing we noted in the upward direction, where every single daily bar is producing a higher low. So in this case, we'll give some leeway to like a gap fill reversal. That's fine, right? That's still a clear hourly higher low. But if we start getting acceptance down here, it at least brings into question, like, are we going to set then a lower high and then roll over, right? This is what the bears want to see play out over time. I would say it's a lower probability outcome as of right now, based on a lot of the things we'll take a look at as we move through today's episode, okay? So with that, the last thing we'll do here is a quick check before the internals with our Fibonacci's from low to high. The 38.2 is telling us that a line in the sand should be here around the daily 50 SMA, the blue moving average on your screen, as well as the top of the Friday gap up from last week. It was a partial gap fill reversal, and that level is at 595.75. 595.75. So that's still making sense from the rally measurement perspective. And we also want to check in on, of course, those intraday anchored VWAPs, and just make note that these clusters will be creeping up and will be right around this gap fill area, daily 50 SMA. So, you know, maybe it was even a little bit, and this is some analysis on the fly, of course, but maybe it was even slightly too aggressive to say that like things start to change a little bit more iffy if we're underneath 599.65. One of the reasons I say that, right, is because of the bar to bar count we were talking about, but also the fact that it was the previous high in the downtrend. Right, that's why I was so focused on that 599.65. But if we add in these additional indications, I mean, it becomes quite clear that if the anchored VWAP cluster is playing catch up, if there's the 38.2, if there's the daily 50 SMA, we might have to give it the benefit of the doubt all the way down here, at least on the hourly chart, right? We know the daily is fine, and again, I hate to be that guy, but it's technically true. You could form a daily higher low here off of that 584.75, but hourly might have to have some breathing room down into this cluster, right, as we've just seen here with our anchored VWAP. So it's always a good thing that we check in on these things in real time. Let's move along to the market internals now and see what's going on from this perspective. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The one thing that leads me to believe that the gap may close to the downside is if we just look at the internals from today's session, we did not have strong volume inflows. As a matter of fact, they closed out. All day, the breadths were battling at divergent, between the two exchanges, but also around parity, right? We had one-to-one reads on the NYSE NASDAQ almost all day, never building out to strong reads there. The advanced decline line was actually negative the entire session, which was somewhat surprising given the gap up this morning that we didn't have stronger internals here. So again, the pullback doesn't seem unreasonable if we look at the exchange level participation. The index score at least kept us on the right side of the trade, not aggressively shorting by being green in here. It's not aggressively green, but it was green nonetheless, so shorts weren't the primary idea intraday, and that makes sense. The cumulative tick does build out slightly negative, so at the exchange level, we're really not seeing that support of like, hey, it's a gap and go, we should really be looking for brand new all-time highs in the blink of an eye. So what the internals dashboard tells me basically is that, in essence, the ideas we set forth about a pullback to set a higher low here really make a lot of sense, right? If you also take a look at the internals from the Tuesday session, let's just go back here for a second. Tuesday, we actually did have strong volume inflows. The advanced decline line was in trend higher zone. We did have a solid index score here, and the cumulative build was strong. So once again, today's divergent internals, when we're looking at what we just walked through, it's not to say that, oh my goodness, the market's going to crash and burn. It's just to say that a reasonable higher low pullback could be more likely since we aren't getting that support at the exchange level for the follow through that price actually gave us on today's session here. Let's take a look at the market profile and see what else we can glean from a different method of charting, if you will. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. What do we see here from a profile perspective? Well, value, we really only have 2 days to analyze here, has certainly progressed in the upward direction, which makes total sense given the gap up, obviously. However, what I want to just focus on for a brief moment is where the point of control is, right? And there's actually a divergence between There's a divergence between the volume-based point of control and the TPO, time-based point of control. Notice that M period here sticking out towards the right would indicate that the most time during the day was actually spent at this level here, but the most volume actually transacted at a lower level. So once again, pair that with your market internals that were slightly, iffy per se. It would be one way to describe them. And now all of a sudden, again, it's another indication that it wouldn't be unreasonable for some sort of pullback out of the ES or just the S&P 500 into the early stages of Thursday, and we'll see where we go from there. With that, let's jump back on over to the platform here, and let's take a look at our good friend, the QQQ NASDAQ 100. We'll see what's going on from this perspective, daily time frame chart. So one of these gaps, of course, has already closed, which was the Friday gap from last week. And that lower wick is technically incorrect. Thinkorswim is printing the incorrect low there. If you want to change this, you can, of course, right-click, correct this bar, and then enter the correct value. If you take a look in the hourly time frame chart, let's just do it together as an exercise. The low of this bar here is at 518.91. So if we just go back to the daily, we right-click on Friday's bar. We said it was 518.91, and then we can just press apply. And in theory, if I close this, now we have a corrected wick. There you go. Learn something new every day. So in terms of the chart in front of us, we know from a trend perspective, very similar to the ES, very similar to the S&P 500, we started to break the resistance trend line last week. One of the concerns we had was that it was still possible, however, even on the Tuesday morning slight gap up out of the QQQ, there was still the possibility of a lower high. Well, today, of course, puts that concern to bed via the higher high, the gap up, of course, and, the downtrend's over. The downtrend is, of course, over on the QQQ. We do have a higher high. So the name of the game, just like the S&P 500, is to seek daily higher lows off of key levels. In this case, gap fill reversal probably captures my attention. Anything further than gap fill reversal, I would lean more so into the 518.50 level and probably not want to see price further underneath that. You could make the similar argument to the S&P 500 and say, okay, we're technically coming from the lowest low. It's very possible that you come all the way here, 510, and then you get your higher low. That's a possibility. But just the way that the QQQ has not yet recaptured the origin of the Powell plunge, whereas the S&P 500, of course, has over 603, that gives me that little bit of hesitation here on the daily time frame chart to say something more along the lines of 518.50 really wants to be the level that offers the higher low if we do get a more severe pullback, right? So that's first and foremost. Daily 50 SMA possibly coinciding for super support. If we start to see, so where do we become a little bit more neutral on this? If we see something that comes into 518.50 and then sets a lower high underneath 526, basically Tuesday's high, that's where I would start to have a little bit larger of a concern that we're still just neutral here on the QQQ daily. Now, once again, I want to remind you folks that we're not shifting bearish, and we're probably not shifting bearish until the weekly chart is underneath 503.25, right? And we know that. This has been the case for a long while now. There's no reason to really get aggressive on the bear side as long as this previous resistance is acting as newfound support. So again, time frame of analysis must match time frame of execution. Yes, we are trying to resolve this in the upward direction. However, the daily trend will absolutely remain somewhat neutral if we see the pullback to 518.50, set a lower high here, and just start chopping around the midpoint of the range. So I'm not too interested in that. I'm not convinced that this is, a clear and well-defined outcome for the remainder of this week. Obviously, with just 2 trading days left in the week, it's possible that we close the gap, and then maybe on Friday we look for some sort of response, and then we'll see if the lower high is ultimately set or something like that into early next week. So one step at a time. You do have your daily inverted hammer, upper wick, of course, suggesting a rejection of the origin of the Powell plunge. That's 533.25. Nonetheless, still a great, target, mission accomplished. We hit the proper target from the overall trade in and of itself, coming off of these lower wicks in here. So all set from that perspective. I think we've covered the daily. We're sort of neutralizing that trend, right? We're looking for a higher low on this time frame over 518.50. Let's drop it down to the hourly chart here and see what else we can learn about the QQQ. Once again, today's gap up, is there any sort of attempt from the sellers to move into that gap range? The answer is absolutely not. So do we have stronger sellers here? No, we do not. I would say that consolidation up here is bullish, builds out a multi-day range, and Brigade bullets like this offer the next long opportunity on this white dot here. I think that there's absolutely, and again, this is like the beauty about being able to trade through different time frames, right? If you're a scalper, then of course there's a short opportunity for a gap close from point A to point B. That would not be a shocking move from the market. However, once again, if you're trying to orient yourself, if you're trying to orient your trades in the direction of the higher time frame trend, and even just this hourly trend here, this is still a counter trend move. I would not overstay my welcome at point B. I would absolutely be thinking about where's the reversal back in the upward direction to basically make an equal high and then seek continuation towards the all-time high that's 539 in the upward direction. For the bears to really build that edge once again, you would probably need to see a move to 518.50. Maybe it offers this. And then this is where I would say if the sellers step up and offer a rejection around this zone, that would become a little bit more concerning for that daily neutralization that we were talking about earlier, right? And again, the point being here is that the daily trend is making strides in the right direction, but we're not completely out of the woods. We're not free and clear of the possibility of a neutral trend developing. Let's come in with the similar indications from the S&P, which of course is going to be your Fibonacci's and anchored VWAP. 38.2 is roughly aligned with that 518.50. I would not call this perfect alignment, but it's close. It's certainly, not even close to the 61.8, so all set from that perspective, 518.50 being reinforced somewhat. If we take a look at the intraday anchored VWAPs, looks like we're getting a weird load here. Let's try auto zoom. Still weird load. Can you give me some space, please? Let's try to just reset this. Let's try 55 bars real quick. There we go. Looks like it was just giving us a hard time, technical difficulties. Anyways, the cluster of anchored VWAPs, 50 SMA, rinse and repeat the analysis from the S&P 500. 518.50 becomes a key level for all of those reasons, right? Let's move along now to our market internals for the NASDAQ side of things. And what do we see over here? So there's a little bit more strength, but I wouldn't call it like, groundbreaking, oh my goodness, market's got to fly to all-time highs. We at least have positive volume inflows. We do still have a negative impression from the advanced decline line and the cumulative build as well, but this is sort of that sneaky, like, okay, not all that bad. You are still getting the reinforcement from Tuesday, and reinforcement from Tuesday here out of the cumulative build as well on the tick. So not all hope is lost, but again, a pullback seems reasonable given what we can see here at the exchange level in terms of participation, right? And a lot of the gain, of course, you could attribute to none other than Netflix, which of course opened on a very substantial gap up this morning. A lot of the semiconductors opened on that nice gap up this morning with the Stargate announcement, $500 billion in terms of AI infrastructure spend. So of course the NASDAQ's going to have a little bit more, at least in terms of volume flows, respect, if you will, and follow through on the upside versus the S&P, which is broader based, of course. So with that, let's jump on over to, let's give that a little refresh, it looks like, the NQ futures, and have a look at the market profile. Very, very normal style distribution where you have that normal curve, something that looks like this, instead of an explicit P-shaped profile, a B-shaped profile, a long drawn out profile that indicates trend. So a very, very balanced session. The value area and point of control are smack in the midpoint. Maybe not smack in the midpoint because this, of course, is ultimately the halfback, but you get the idea. Very close to the center of the overall range. You did not have value accepting towards the highs, point of control up here. So I think it's really a one step at a time. If we break the low, maybe the gap closes underneath. One of the things you could watch out for here is because we do have A-period single prints, right? If you were to see the NQ futures accept underneath basically 21,965, then that could be your precursor to the potential gap close, right? You could look for a Brigade Bolt lower high here intraday that's under 21,965 to then get to the low of day and then seek the full gap close on a break of the previous day's low. So if you're looking for that scalp to the downside, that would be a premature indication that I would certainly watch and lean into here. If you want the equivalent on the QQQ Cash ETF, that would just be underneath basically the low of day pullback, which is here at 531.10. 531.10. I don't want to get too level happy on the chart, but 531.10 could be something that you monitor for the early indication of getting into this gap down here for the single print reasons we just talked about on the NQ futures. With that, let's finish up the broad market indices with our good friend, the IWM. Small caps over here have done something quite impressive. And that, of course, is just the recapture of our 227. The fact that previous support, and even if I go further, right, we know that the origin of this is previous resistance, then turned to support, was now acting as resistance. We actually gapped up and over that on the Tuesday morning open, got a rally, and on today's session, it's just an inside bar. So no gap up follow through out of the small caps here today. Again, reason being is that this is not going to be impacted by that Stargate announcement, the AI infrastructure spend. However, the inside bar does give us an opportunity to just watch for inside bar rules, basically, which is that if we take out the highs, looking for range expansion higher. If we take out the lows, what does it turn into? Not just an inside bar breakdown, but it more importantly turns into a look above and fail. And I would certainly take that as much more of a headwind for the S&P 500 if you notice that a lower high is starting to be built underneath 227 intraday out of the IWM small caps, right? And where's the larger gap here? It's the CPI gap. So I think that the catalysts for small caps are going to be pushed out to exactly a week from today. Next Wednesday, of course, is the FOMC meeting for January. We'll hear from Jerome Powell, the Honorable Jerome Powell, and see what he has to tell us in terms of the inflation and labor situation. And we'll make some assessments as to whether or not the market feels as though it's appropriate for 1 rate cut, 2 rate cuts, or heck, dare we even say it, rate hikes in 2025, right? So in addition to the things I was mentioning in the intro, where like if something doesn't hold, the rally will fail, I would probably keep a very close eye on the 10-year yield, which we'll get to, of course, in just a moment, around like 4.65. That's the number that we really want to focus on there. And of course, that will have a substantial bearing on IWM, small caps. Notice also that we're being pinched by the daily 50 SMA. We did not gap up and over this. We're still underneath. So are we out of the woods here? Is it smooth sailing? No. Is it the early stages of a trend reversal? Absolutely. And again, we're trying to give credit where credit is due. From a swing trading perspective, again, guys, I didn't fall off the turnip truck yesterday. I know that the expected value of the trade is greatest towards the lows, buying this for a weekly higher low. I get it. But the time to explicitly call that the daily trend is back in the upward direction is when we have the higher high and then some sort of subsequent higher low, right? So that's what we're watching out for. In terms of IWM, we know what the key level is, 227, have to stay above. If we do stay above, bullish consolidation here, looking for upside targets. If we fall back in, it gets a little bit more dangerous seeking that gap close at 220.25 at minimum. On price acceptance underneath 227, I would be looking for this, which once again, it's not that there's a trade per se in the IWM. You could trade it if you'd like, but it's just going to act as a headwind for the SPY, right? That is the IWM daily. Let's quickly take a look at the hourly. So anything interesting to note here? Just that the highs are very equal back to back, which typically does not suggest the proper end of the auction there. So if we do start to see any support, like on a full retest, on a full hourly retest of 227, if we get buyers to step up here, let's say it looks like this, I would start to call for inverted head and shoulders, right? And what should the target be? Right back to the highs, repair the improper end of the auction, which should be bullish at that point intraday. If we get this to unfold, if we find support, if we get buyers off of 227, then we're still rocking and rolling in the upward direction, and we are seeking those upper targets as we've already mentioned. If we get that look above and fail, here's the look above, here's the fail back within, I would at least target this, if not the full gap close. 220.25 once again is that number. Let's come in here with the Fibonacci's from the low up to the high. And our 38.2 is confluence with the top end of the micro range, right? This being the micro range from in here. The way that we sort of, I wouldn't say, maybe disrespected is an okay word. The way that this disrespected that level through here and just sort of chopped around means I'm not as interested in it per se, precisely at 224.25. Is it possible that a daily higher low forms there? Yes, but once again, I think that this remains too much of a threat. If there is that deeper move to test the 38.2. So fibs don't really give me a huge vote of confidence. I think that if anything, the 61.8 indicating the gap close just makes for a good target if this does roll over and give us the bearish setup. So no need to jump the gun. If we're over 227, we're not bearish yet, but we're watching it very closely. Watching that level like a hawk, no pun intended, for of course our Fed indications hawks and doves. Let's come in here with our intraday anchored view apps and see what else we can learn. Maybe the cluster is right there at the 224.25. It can act as a key level from that perspective, but I primarily think that we want to keep our focus on 227. Very simple, no need to overcomplicate the IWM. Let's come in here with the Rusty Russell market internals and see what's going on from this perspective. Volume outflows today. It was an inside day, right? Advanced decline line was in the red all day, and the cumulative build was actually quite substantial to the downside as this selling was taking place. If you actually just look at the distribution of the tick bars themselves, which this tries to summarize, right? But it just becomes very obvious on today's session that like all morning, the tick was negative for the Russell. Just a little bit of positive action here and ended the day fairly negative as well, which makes sense, right? Because intraday, this was just kind of a bear flag into the afternoon. So very, very carefully watching, like a hawk, as we said, that key level here, 227 out of the IWM. Let's get back on over to the market profile and finish up our indices with the RTY futures. Over here, we've got a couple of additional things to point out, namely the fact that, again, this is a mechanical high because it's so precise. It's the improper end of the auction. We also have, notice the poor low here. We have technically a poor low here. and a poor low here also. If I expand this, do we get anything that resolves a little bit better? Not really. I mean, I would call this lack of material excess. This is still a poor low. This is still a poor low. So I would watch these lows very, very closely. The indication that this basically tells us is this should get taken out, right? That should be repaired. And then it becomes a matter of, okay, if we take it out, do we move inside of and underneath the weekly pivot point, which here on the RTY futures is roughly around 2310, very close to this low. So do we take that out and find acceptance down here? Or do we take it out and promptly get acceptance back inside of range? For in this case, now we're sort of traversing timeframes. We're talking about a bar to bar, look below and fail. Instead of the daily, look above and fail on the range and the weekly level, bar to bar, this would be a look below and fail back into the range, in which case I would expect what? A rotation to this, the mechanical target up towards the highs, right? That would be the next target. So very interesting stuff here out of the Russell. If you want to keep it simple, if you're like, dude, just tell me the levels, 227, watch it like a hawk. If you're above it, remain bullish. If you're below, be a little bit more cautious and probably even take that as a headwind for our S&P 500. Speaking of which, let's get back on over to the S&P. Let's rip through our sectors. What does the weekly performance look like thus far? We have the XLK tech sector leading the pack up 2.77%, followed by semiconductors, followed by the communications sector up 1.2%. Very strong display of strength, obviously, on the gap ups this morning via the announcement, Stargate, as we've been mentioning so far. And what does this mean? Well, these are heavyweight risk-on sectors for the market. That absolutely is bullish as we're coming off of these lows and barreling into the all-time high, basically. At the bottom end of the barrel, it's energy, so that's disinflationary. That probably helps the Fed's case to lower interest rates. The market will like that, right? Utilities backing off. Those are D for defensive, all set here at the bottom end of the barrel. XLY, probably don't want to see that underperforming. The only thing that leads me to believe that we're not doing so bad there is it's not even a full percentage point in the red, right? It's about 54 basis points, but it's not dramatically red per se, totally lagging the market and just getting left in the dust. Not at all. So with that, let's jump into some of these structural charts and see exactly what's going on from that perspective. This mechanical high, the almighty mechanical high, is being tested in the XLK, the technology sector, the heaviest weight risk-on sector. So with the gap and go, I think we have a couple of outcomes here. I was a little discouraged. I'm not going to lie. I was a little discouraged with the way that this range was sort of resolving back down over here, the opportunity for a lower high, the fact that it was under the 50 SMA as of Friday's close. So today's gap and go is quite impressive because it gets us over the previous all-time high from back here. It gets us back to basically within spitting distance, striking distance of this 242 level. Consolidation, Brigade Bolt, bullish for the S&P, seeking new all-time highs. If we get a gap closed, you get that gap closed and you get the pullback in the S&P. And if this can hold and get back to the equal high, I would expect that to break. Once again, this is the improper end of the auction. Auctions typically end on a euphoric bang, right? If you could literally just make the draw the comparison in your mind between a car auction, any sort of auction really with a physical good, right? It's two bidders at the very end going back and forth. Who's got the best bid? Who's got the best bid, right? And those people are crazy compared to everybody else. But that's ultimately what gives you that euphoric high, right? And then finally, when one of those bidders throws in the towel, that's where the transaction takes place. There are no more buyers. That's when the market pulls back, right? So anyhow, this is improper. This is still like we have consensus among the auction hall, and everybody's like, yeah, we're good with 242. Nothing has gone crazy yet. So you need that euphoric high here to put in some sort of like capitulation top in the, and the takeaway just from a trading perspective, like why do we even talk about this? Is just that we're expecting this level to break at some point in the near-term future the more we test it. That would be bullish, right? Anyways, let's move along. Semiconductors. As mentioned in the introduction, semiconductors need to stay over the top end of the range. We had look above and fail once, twice, 3 times. Can't make it a fourth. Really can't make it a fourth. The one thing that's decent about this, of course, is that we have started to close the overhead gap here. We do have an inverted hammer on today's session, so any sort of movement underneath 264.15 wouldn't be unreasonable to come in for that test of 256, but once again, that is a must hold. Must hold. No ifs, ands, or buts about it level. 256. Top watch out of semiconductors. If there's a pullback, obviously it doesn't have to pull back. Consolidation up here is fine, in which case we're Brigade bolting over 270.34 into the all-time high. Okay, so bullish until proven otherwise on the semiconductors. Another great hold of the daily 200, the daily 50, and we're finally out of the range. Let's make it stick this time. Buyers have to make this worth their time. Okay, Next up, communications. Let's speed through the remainder of the sectors. I like the fact that we have a higher high. Yes, it's a red inverted hammer. If it pulls back, that's fine. There's plenty of opportunity for a higher low. I would be more concerned about this if it starts to breach and make an equal low. If we have equal lows, or if we're not holding up around this area on a deep pullback, I would be concerned. But as of right now, the chart structurally does look like it has an offering for some reversal back to the all-time high over time via continuation or a pullback, right? Let's jump into industrials. Really strong recapture of the neckline over here. Hard to say anything bearish about this chart. Plenty of opportunity for a higher low over the 50 SMA. I'm honestly a little surprised, if I'm being quite frank. I'm a little surprised that there was no attempt from the sellers to try to keep a lower high here underneath the neckline of the double top. So bullish until proven otherwise. You can start to see the reversals we're getting across the sectors. Speaking of reversals, do we see one over here in the XLV? The answer, unfortunately, is no. Big opportunity still for a lower high. Thankfully, this has been demoted to now the fourth heaviest weight sector by market cap. It's also D for defensive. So not the worst thing in the world to see it lagging in terms of a trend perspective. The other sectors we've seen so far, I would say if it is going to do something meaningful, it would have to produce like higher low consolidation in here and then break out, in which case you might be able to say we have a sick and twisted, inverted head and shoulders, break the neckline. Maybe it looks something like this with a trend line from the all-time high. Maybe we get a trend reversal out of that, but one step at a time. At least it's not bearish pressure for the S&P by breaking down and making new swing lows underneath 136.50. Okay, so watching that. Next up, XLV financials. JP Morgan running away like a freight train. All of financials really great continuation out of the market here after earnings, holding the gap up over the 50 SMA, over the neckline of the head and shoulders. No complaints out of the XLF. Plenty of room for a higher low here, seeking that move in the upward direction. So instead of being somewhat worried about the downtrend there, obviously the gap up, earnings season has certainly changed the tone out of this move. So it's bulls on parade. That, of course, is the second heaviest weighted sector by market cap. Energy pulling back, as we've made note. That is good from an inflation perspective. We'll see if the sine wave wants to continue. All the mathematicians maybe got that joke from the weekend video. If not, then that's fine. That's fine. What else is going on here? Utilities. What do we see out of Utes? We have ourselves a possible retest for a higher low here. As long as it's not making new swing lows, again, it's not offering downward pressure for the market, we're okay. This is a lightweight D for defensive sector. We're moving along. Next up, discretionary. This is a heavier weight risk on sector. I like the fact that the consolidation is over this balance from down here. So yes, the market's not really going anywhere, at least out of XLY discretionary. And yes, it's technically down about 0.5%, 50 basis points. But is it doing anything structurally that tells us we should be concerned about the trend outcome? No, absolutely not. From this cluster to this cluster, we have a higher high. From here to potentially just consolidation here, we have the opportunity for a higher low over 227.50. So all set. Once again, we're starting to get this reversal. It's starting to become a little bit more clear that markets can resolve in the upward direction towards these highs. Let's take a look at materials. This is the lightest weight sector in the S&P. It's recaptured this level, so I suppose that's a decent indication, but is there still an opportunity to tangle up here and get a lower high? Yeah. Until it's actually making a new swing low, because it's the lightest weight sector, I don't think it's worth, getting overly, worked up about there in the XLB. What we can look at as a proxy, though, is the XHB for home builders to get a sense for this. And we've gone through this comparison in the past. Let's just throw it on there. Comparison line. And we'll throw in the S&P 500. I think it's the default. Yeah. So these two things typically don't stay disjointed for too long. The fact that this still has an opportunity for the lower high at the moving averages and still underneath this key structure versus the XLB materials actually getting over this level on a relative basis, a small area of concern and maybe something that you want to continue to monitor here from a divergence perspective. It's not enough to go out there and just start shorting the market with both hands, but it's something to just have in your back pocket. If you are someone who leans a little bit more into the short thesis, someone who says, I don't really want to be a buyer of the market up here, this data point is for you. But again, what's the point of going through all of these data points in every single one of these analyses, right? It's basically so we can weight the evidence, look at a broad data set of evidence and say appropriately, okay, we can see like maybe 3 data points that are bearish, but there's like 50 data, and not exactly 50, but you get the idea. There's a larger majority that are bullish, right? And as of right now, I do believe that that's the case. This would sort of fall into like, okay, there's maybe 1 or 2 bearish data points, this being one of them. Let's move along. Where were we? The TLT is what we want next. We can get rid of this comparison line. I think we're all set with that for now. Let's remove. There we go. TLT is certainly putting in what looks to be the beginning stages of maybe some sort of reversal here off of that 85. I still maintain the short strike puts at 85, just FYI. Probably going to hold them just until they either expire and they're at zero, or if I get assigned on, let's say, the Fed volatility is like, nope, we're actually going to hike rates or something of the sorts. Maybe this happens, right? Maybe we get assigned to 85, in which case that's fine. I'll farm the yield, right? So anyhow, I believe that there's an opportunity via this gap up to produce the right shoulder though, and still technically have this move in the upward direction, especially if inflation starts to subside. We've seen that the labor market has remained quite resilient. There are some anecdotal headlines right now floating around about like a handful of layoffs, but the one we read this morning was that 300 people were getting let go from Stripe. Of course, it sucks to be one of those 300 people, and we're not saying that it's an easy thing to lose your job, but unfortunately, or depending on how you spin it, maybe fortunately for the market, 300 layoffs is nothing. It's not going to move the needle for the labor market's health, so to speak. So could it be a sign of more to come? Could it be a harbinger for what's coming down the pipeline? Maybe, but we trade the data that's in hand, and tomorrow morning we get the jobless claims, and I think that is going to be our purest form of data, right? We're not just going to make conclusions on anecdotes. We're going to look at the data when it comes out. Let's move along to real estate. Obviously, with rates backing off a little bit, this is moving higher. Still a big opportunity for a lower high here, which I think would somewhat align with what we saw out of the XHB home builders. Finally, consumer staples really lagging down here, which is kind of a shock considering some of the headlines we saw this morning with Johnson & Johnson, Procter & Gamble really reporting solid earnings. There was a little bit of a gap up here in the sector, but it faded all day, and we're actually underneath this big pivot again. Thankfully for the broad market in terms of the S&P 500 and its performance by itself, this is a lighter weight sector, and it's also traditionally more D for defensive, so I'm not overly concerned with the performance down here, the underperformance from consumer staples. With that, let's jump on into some sector ratios, and we'll see what's happening from this perspective. If you're not familiar with this dashboard or how to set up ratio charts on Thinkorswim, check out the video tutorial there. The biggest thing that I think we want to lean into here is the rotation. The rotation that's taking place, right? We knew that financials really fueled the first sort of leg off of the direct low in the S&P 500, but now look at technology with, of course, again, the Stargate thing. How many times am I going to reference it? Probably too many times. As long as this can, keep some of that relative strength, I think we're all set. I shouldn't say all set, like, hey, fine and dandy, throw caution to the wind. That's not what I'm saying. But, the rotation aspect here would be, in my opinion, more of a bullish data point than a bearish one. XLY still looks fine, even though it's underperforming on the week. It's still over that 50 SMA, clearly in a nice uptrend here. XLV in a downtrend is not an issue because it's D for defensive. This is defensive, it's in a downtrend. This is defensive and it's in a downtrend. We're not concerned from a risk on, risk off perspective, and we can even see that here in the specialized ratios where we're getting improvements now, right? I specifically recall in the weekend video saying like, hey, look out, right? This and this, our XLK components are a little bit weaker because technology is lagging. Now that's not the case, right? We've clearly smashed right through the 50, right through the 50. That's bullish. These still retain their bullish edge as well. It's hard to say we have a risk off rotation on our hands. This is absolutely more of a bullish context than a bearish one. So at the very bottom of your screen, we're looking at the Japanese yen, of course, and this is important because on Thursday, and we'll bring up the economic calendar in just a moment, Thursday at 10 p.m. Eastern time, 10 p.m. Eastern time, the Bank of Japan makes their decision. We're, expecting a highly anticipated 25 basis point hike. If they go any more than 25 basis points, that's where I think we run into trouble. This surges in the upward direction, and God forbid it turns into something like August. We get the yen carry trade unfolding again, and people panicking, throwing their hands in the air saying, oh my God, market's falling. It's possible. It is a possible catalyst, and we'll keep an open mind to it, but the Bank of Japan would really need to shock the market with a jumbo rate hike, not some sort of, more mild and once again anticipated 25 basis point hike. Let's move along to, speaking of currencies, the dollar will be a great place to start. A little bit of a gap down here this morning, which is not this morning, but just over the span of the week, moved to the downside, which is a little surprising given the tariff talk, of course. And I think one of the things that we're seeing here, and actually ECB, the ECB, European Central Bank's Madame Lagarde, actually said this morning that Donald Trump was taking a responsible, and I think the quote was, air quotes, very smart approach to the slow rollout of tariffs. So we'll see how this plays out. But regardless, the point being, I think the market in here, once the election was sort of won, was like, okay, well, like, geez, let's buckle up here. The tariffs are going to come hot and heavy. When in reality, right, we're already seeing this sort of like slow rolling out of how it's going to be done. And that's possibly giving a little bit of reprieve to the dollar. So just one idea here out of the Dixie. Let's take a look at the gold contract. This is technically the gold ETF, but is there a flight to safety? The answer is no. We're still at this breakout point. I would not call this like an aggressive uptrend, an aggressive breakout. It still has the retest opportunity for a Brigade bolt above, and we'll keep tabs on it. But so far, with the market rallying aggressively as gold also drifts in the upward direction, you're just not seeing the ratio move aggressively higher. So not real. The market's almost saying like, hey, we're maybe okay here from an inflation perspective, right? If gold was rallying and the S&P was sort of more stagnant, if it did not see these gap ups this morning, that would be more of a concern. So we'll check back in on Saturday. I'm curious to see if we end the week with a higher low or if we actually drop back down underneath the inflection point there. Let's take a look at interest rates. And we can see, as mentioned earlier, that the 4.65, which is basically this pivot right here, becomes the key watch. If we remain below, I mean, classically, from a pattern perspective, right, there's your head and shoulders, probably looking for lower through the thin structure retracement, retest 4.3. Or if we take this back out, I think the pressure's back on for equities, and we still have that path to 5% on the 10-year yield, right? Think about the weekly down below. That's why I've replaced the S&P with this weekly 10-year. You're still getting, I mean, this is just a mild pullback in an uptrend, right? So let's not lose sight from the higher time frame idea, but at least in the short term, into the end of the week, basically, if we see consolidation here, and obviously not a shock, it's the inverse to the TLT, right? There's your TLT, inverted head and shoulders, break the neckline, get the retracement. It's the same thing we just talked about over there, right? So with that, let's jump into the inverted ZT, which is basically the 2-year yield. And what we have over here is a backing off, which is, of course, helpful for the market. That's aligning with what we see here. It would not indicate the lack of a breakout here. It does not indicate that we should be planning for more rate hikes. Let's take a look at the Fed tracker tool, though, just to hear it straight from the horse's mouth. What do we see? Certainly dealing with that June timeframe meeting as the higher probability timeframe for the cut. And we're looking at 44.8% odds of that as of right now. Obviously, this is subject to change a week from today, next Wednesday, when we have the FOMC actual press conference from Jerome Powell, and here is commentary, right? So I wouldn't put too much emphasis into this right now. It's been as far out as September. It's been as high as, I think at one point, and this was really, really early on, like right after the Powell plunge originally, it bumped all the way back out to the March timeframe. So anyhow, we'll keep tabs on that. Generally speaking, the further this gets pushed out, the more bearish that is for the market. The further up it gets pushed, the more bullish it is for the market, just under the pretense, that the operating conditions will get easier for small caps, notably, and you'll get you'll sort of see a breadth rally at that point. And we'll check in on breadth in just a moment. Here's your economic calendar for tomorrow's session. This is the full Monty. We have the jobless claims at the 8:30 timeframe. That's really what we're watching for. Obviously, inauguration on Monday. We've been having the WEF World Economic Forum meetings all week. So watch out for headlines that come from that, but really no market moving economic data here this week. Jobless claims is a week over week thing, so we'll keep tabs on it. Manufacturing and services PMI on the flash side are not as important as the ISM, so not really worried about that. Keep an open mind for any sort of volatility here at 11 a.m. tomorrow. Looks like President Trump is speaking. I don't know. Do we have any insights here? Due to speak at the WEF via satellite. Broad range of subjects, only speeches, So anyhow, this is it's worth keeping an eye out for, right? Maybe some market volatility, and of course the new regime, the new era that we're in, basically should suggest that volatility will increase with this administration. So we shall see. Things to keep in mind. Obviously, as we look out to next week, as we've said already, it's the FOMC. Those are your fireworks on Wednesday, January 29th. 2 p.m. Eastern Time, 2:30 is the press conference, and we will cover this live here on the channel that Wednesday at 2 o'clock. All right, that is what we have from the fundamental perspective. Here it is, the Bank of Japan side. This is what I wanted to remind you of Thursday after the close. There it is, 10 p.m. Eastern Time, the decision from the Bank of Japan. So expecting that 25 basis point hike, you can see here, the consensus is for a 0.5 from a 2.5, or 0.25. So unless there's a surprise, unless there's a jumbo hike, I think that we're pretty much all priced in at this point, and the market should be able to digest and handle that with no issues. Here's the earnings calendar. Obviously, Netflix knocked it out of the park on Tuesday after the close. Huge gap up, just barely getting up towards that 1,000 big Jesse Livermore number on this morning's gap up, fading for a majority of the session after that, but nonetheless, right up against the $1,000 figure. For today, what do we have after the close? Nothing really interesting here. We were talking about earlier on in the show, the pre-market show, GE Vernova has been interesting from a energy production perspective. Aerospace might be interesting with this whole concept of like, hey, we're going to Mars, right? CSX should tell us something interesting about industrial freight, and American Express Friday before the open, rather, will tell us something about the state of those higher end consumers and even businesses who are spending on Amex, right? So watching out for those as your honorable mentions. And with that, we'll get back on over to the platform. We'll finish up today's episode of the Midweek Market Update. Here we go. TLT ratioed to the S&P, not an issue, no flight to safety here. It's echoing what gold is telling us. If we look at bonds relative to themselves, they are still pulling back for potential higher lows in overall uptrends, and uptrends. So is the market still somewhat uneasy about inflation? It would seem so. Another thing to take away here, and we went into a deeper conversation about this on Saturday, is just the possibility that the Fed needs to find a higher neutral rate, given that inflation might run hotter than the expectation. Now that we're out of there's no more ZIRP, right? We're not going back to ZIRP. Imagine what the market would do. Imagine what would happen with inflation if we went back to ZIRP. It would be out of control. So the Fed probably has to find a higher neutral rate, in which case these ratios might remain in subtle uptrends for longer than we expect. Just something to think about there. As we move along to credit spreads, these are cooling off a little bit here, more importantly down here on the junk bond side versus the corporate side. So watching out for those indications should indicate volatility is slowing down a little bit, which makes sense as we're pushing new highs. Let's move on over to junk bonds by themselves. The positive divergence played out from here to here to here, right? So that has been a solid signal thus far, giving us follow through in the upward direction. Notice though that your S&P has gone on for that higher high and stuck, whereas this is actually fading off already, basically to an equal high to prior, right? On a relative basis, HYG might be somewhere in here. So does it mean that the pullback idea we had sort of started the show with in the S&P 500, something that looks like this, does that seem reasonable based on what the HYG is suggesting here? Absolutely, I think so. If we look at the LQD, which is corporate grade, what do we see on this? I like the recapture here. Remember, one of the threats we talked about, right? There was a balance between the threats and the recapture. We had the junk bonds, HYG showing bullish, LQD was like neutral. The fact that this is producing acceptance over the flat flush point from back here, bullish. Back to bullish on LQD as long as that holds up, right? Let's move along to the good old BTC. And of course, there's a little bit of panic with the Trump meme coin that was launched over the weekend, just absolute madness. But nonetheless, the top dog here, BTC, is holding up just fine towards the top end of its bull flag range. I really don't see a reason to get overly concerned about this yet. We still also have a bullish indication out of the Saylor shift ratio. Let's move along to, if we moved into, here it is, total breadth. This is what we were talking about from an interest rate perspective, where I think it's worth continuing to monitor what the Fed says and where the interest rates end up being pushed out to in terms of cut versus hike, or how many cuts I should even mention as well. If we see that the cuts turn into 2 after the FOMC, and again, this is next Wednesday we're talking about, but just starting to prepare what we're watching for, right? If those get pushed and we're seeing 2 cuts instead of 1, I believe that we're probably going to see a rally based on breadth. So improvements here. So we avoid a look that is like what we saw back here, and we equated to the weekly pullback that we were talking about back into the end of 2023, and we see more of a breadth rally, right? Which is like the back half of this over here anyhow. Right, breadth rally. So that is top of mind there. If you want to keep it simple and not watch as many funky charts like that, you could watch the RSP. As long as the RSP produces a higher low over 178 on any pullbacks, and again, I'm not saying it has to go here, but as long as we're above that, bullish on the breadth perspective and that breadth rally idea. If you look at the QQQE, it's very similar in terms of how we're already up and over that 94, and over here, right, we're just back up towards those highs. If we were still lagging inside of the range, yeah, that would be a red flag, but that's not the case out of the equal weight thus far. If we look at Dow Jones, of course, a little bit of a rally here. I'm still somewhat concerned about the retest lower high under the double top neckline, but one step at a time for now. It does seem as though this is playing nicely for at least an opportunity to get there. Right, so we'll watch out for that. Let's move along to some volatility indications. VIX coming back down to that 15 floor. Don't be surprised if 15 starts to act as the new floor with this new administration. Things get said off the cuff. A little post goes out here and there. Market's going to be on edge. The market has not forgot what it was like to trade between 2016 and, of course, 2020. So if the VIX ends up finding a higher floor around 15 or something of the sorts, it would not be all that surprising to me. From a posture perspective, we know that this chart spread over here has really been our bread and butter the last couple of sessions, so we'll continue to lean into this. I've updated these contracts, by the way. The recent contract expired today, right? If I just open this up, actually back to the VX, yeah, this F contract, the January contract, is expiring today, so please make sure you update your charts there in terms of what the actual expiries are. Nonetheless, the fact that these are all off of the zero line, the fact that the spread is correct, this is the most near term, this is the second most near term, third and fourth, of course, so the spread's correct. We don't have any inversions here. This is starting to flatten. We'll watch to see if it drops to zero on maybe any influential statements or policies that go through, but for now, definitely in a contango, which is bullish for the broad market from a volatility posture perspective. Let's get into our core list of companies here. NVIDIA kicks us off on the daily time frame chart. As we know, this is still a balance range. If we can spot some sort of Brigade bolt high or low over 140 from the daily perspective, if we get a higher low at the midpoint at the daily 50 SMA, which by the way is like completely flat at this point at 140, kind of crazy. If we get that, then I would certainly be interested in those opportunities to rotate to the top of the range. But if the whole infrastructure spending bill is going to go through, or just the investment, I shouldn't say spending bill, but if the investment is going to come through, right? It was promised by SoftBank and Sam Altman and Larry Ellison, I believe, were the three key players. If that comes through, then like I could see this continuing to just drift in the upward direction. So the premise here is continuation is fine, or pullbacks to offer a higher low are also fine as long as we're over 140, right? On the hourly time frame chart, the level and retracement I'm most interested in actually sort of unfolded today with this, partial look into the gap, found support over these previous highs, close to 143.25, then rallied in the upward direction through this thin structure retracement. That's exactly what we've been talking about over on X, right? So for the most part, that trade, I don't want to say it's complete. There is still a little bit more range to travel in the upward direction, but this nice long on either if you had it through the gap up or if you had it off of a little bit of that pullback off the open. I think Amazon was a little bit easier to execute, but again, we'll talk about that in a minute. Generally, it's bullish, right? There's nothing here that is overly aggressive on the bear side out of NVIDIA, and I think we want to carry that forward. Moving along to Microsoft, no longer the exclusive cloud provider of OpenAI, which is interesting considering the 50-50 or 49-51 partnership that they have or whatever. Anyways, what do we see here? Opportunities for high or low, maybe change things. Microsoft, I think, is interesting. Apart from this gap up this morning, this chart was absolutely abysmal, right? It was really, really tough. If you look at the daily time frame here, I mean, yeah, the gap up changes things, and like hindsight heroes can come out of the woodwork and say, oh, no, this is the greatest long since sliced bread, sure, whatever. But really, it's just been in a balance range. So from a trading perspective, in here was horrible. Horrible. So going forward, I think earnings has the opportunity to change this. I think this rally, if it's going to stick, has the opportunity to change this. It needs to stay over the top end of this range. We need to see, instead of a failure like what we had there, we need to see that support high or low over 441.25. So watching that very closely. And again, earnings will play a factor into this as we head into next week. Let's move along to Apple. Atfield over here has a great opportunity for a dead cat bounce. An explosive dead cat bounce near the daily 200 SMA, inside bar from today's session with nothing but a gap to close overhead. So over 223.75, certainly, I think that the bottom fishing approach is appropriate here for something that looks like this intraday. Let's take a look at the hourly chart so you can see this, right? The idea would be if this is a double bottom and this is a neckline, or you could call it a cup with a handle, whatever you want to call it, it doesn't matter. But if we get this, right, that's where we start to play in the upward direction. There's a thin structure retracement, that's your target, and your risk hopefully is able to look something like this if you can spot the setup on a 5 or 15 minute time frame chart. 2-minute chart if you're quick draw McGraw, that's the name of the game. 223.75 closes 228.35. When we get here, I would absolutely reevaluate. Reason being is that we know the daily chart is in trouble. We know the daily chart's in trouble. So this is a counter trend move. It's a trade until proven otherwise, right? So that is Apple. Let's move along to Amazon, which has just been an absolute beauty this week. Could not have asked for anything better. Breaking out of this on the gap up from, of course, Tuesday's open. Perfect gap fill reversal. Right back to the high of day. Today, holding up over the previous all-time high from back there. I mean, come on. That is textbook bull flag breakout on Amazon. So the trade, if you're not already long, if you have not already scalped it on both the Tuesday and Wednesday session in the upward direction, I don't want to say you're late to the party, but you kind of are. There's nothing saying it can't continue into blue sky territories. That's always an opportunity, but please just be mindful at this point that the highest expected value of the trade is, of course, at the very bottom. The next highest value is probably the gap fill reversal in here when it became clear that the flag was breaking the resistance trend line. And now, as you start buying it long and long and long and long, you're just you're basically exposing yourself to pullback risk, right? So just, whoa, funky little drawing tool there. But let's drop it down to the hourly chart. And I'll reinforce what I mean by this is like if you buy this up here, right, and you're long at this level, and technically the chart pulls back for a daily higher low here, technically the chart hasn't done anything wrong. The chart's still bullish. You have lows, higher lows, higher lows, and you need to be willing to like accept that a higher low can still be produced here. The chart's not bearish, but if you're long from here, you need to be able to withstand this drawdown, right? So finding risk reward entries on Amazon will become tougher as it pushes into higher highs and blue sky territories. It's not bearish, but it just means you need to be mindful of your trade location if you're entering new money longs, right? So that's that. Google, what's going on over here? I think that if the broad market pulls back tomorrow, Google is a top watch. Google is a top watch because it has back-to-back inverted hammers, rejecting new all-time highs, closing back down underneath this 198.85 level. So if the broad market pulls back, you better bet your bottom dollar I'm shorting Google, or I'm looking at least for the short. I want the setup here on a look above and fail from the balance range, right? And I'm not targeting the full bottom end of the range in one day, but a decent little breakdown here to get to the midpoint, the previous all-time high 192.50, that at least seems interesting to me. So how do we trade this on the hourly time frame chart? Notice here's the look above and fail. Here's your intraday lower high, right? So there's already an hourly lower high. Equal lows, if they get swept with a lower high underneath, you have risk, reward, right? So that's really how I'm looking to play this Google trade in the downward direction. Very interested in the setup headed into the remainder of this week. If, this is the caveat, right? Don't come back to the show and say, hey, I shorted Google. If the broad market's weak, we short Google. If the broad market's strong, we just pass on the setup, right? We're more interested in trading Amazon continuation, maybe NVIDIA higher low pullbacks. I mean, heck, there's nothing like you could even get crazy and say, Matt, I understand what you're saying on the hourly, and I get it if the broad market is weak, but take a look at the weekly, right? And we did this in the Saturday video, right? There's technically you could call it a bull flag from this perspective. You could call it cup and handle. You could say we're staying over the previous all-time high. I get it, right? On the higher time frames, Google is not inherently bearish, but the two back-to-back failures, at least intraday, intra-week, does not strike me as being the most enticing for a long just yet. All right, so that's Google. Next up, we've got the metaverse. Let's go back here and let's reset this to a daily time frame chart. Metaverse is showing us what? Target hit, all-time high, all set there. Not the best close here, and I think Zuckerberg's under some fire, when it comes to those wandering eyes. If we take a look at 623, what do we have here? Maybe a higher low opportunity. If we could build that out, I might be interested. Might be interested in some sort of prove it to me that the upper wick is not going to stick and this thing's going to get nasty, where this is the daily bar expression basically, but show me some sort of sweep of this and then get the higher low back above. I would look for the retracement back into the all-time high at 635.25. Not bearish on Meta by any stretch of the imagination until there's acceptance under 607.75. Next up, Tesla. Elon Musk, speaking of all these, big time CEOs who were at the quotes party on Monday, not getting the love here out of Tesla. So 415 needs to continue holding if the buyers are going to retain some sort of edge. And the way that I would continue to sort of look for this trade to develop is basically this. I want to see this higher low right here, risk reward on the intraday to take that setup. I'll remain bullish if we're over the 415, but the way to execute it is that this turns into a double bottom, right? And then you Brigade bolt over the neckline at 426.85. So watching that out of Tesla, if it falls underneath, is it maybe left head, right shoulder, neckline break? Maybe. I would not be an aggressive short in Tesla here until there's some larger thesis at play. And, the larger thesis might be on the daily time frame chart, something like a lower high from here to here. But how does that build out as a lower high double top underneath the neckline at 377, right? So one step at a time. JP Morgan speaks for itself. Once again, Mr. Demon wants it all. Looking for continuation out of the inside bar setup. If it does pull back, it's fine here at 255.50. It's fine here anything over 248, right? As long as we're over the top end of this previous range, no issues out of JP Morgan. Finally, we have Netflix. This is something that I would encourage you to let the chart play out here a little bit. I don't think that we want to be aggressive, just sort of swinging for the fences. One thing to point out is that we gapped up big time over the market maker expected move, which is this range here basically. And the fact that Netflix started to fade off instead of rally would just tell me that the market makers who were offsides basically by being short calls up here did not aggressively have to step in and buy the underlying stock to offset their delta, right? So, I would think that things have neutralized so far, and for that reason, if we come back to this level, which is basically the previous all-time high shelf, If we get a retest of that, that's probably where I'm interested in some sort of idea unfolding at 936.50. But outside of that, I would let some structure build out before we start aggressively looking for setups, okay? So that's Netflix in a nutshell here. Let's move along to the two additional trade ideas. First one, COIN, Coinbase, of course. And the idea here is the Tuesday lower wick clearly showing support back over the double bottom neckline, right, at 280.50. When Bitcoin looked like it was struggling a little bit, this lower high was somewhat attractive for like the Brigade bolt to the downside. But seeing now this price acceptance on Tuesday with the lower wick over the key level, I would tend to think over these three equal highs, there's probably a level to pay attention to in here. Let's refine that on the hourly real quick. Let's take a closer look and zoom. Yeah, it's actually pretty spot on. 320.15. You guys know me, round numbers only up here in the penthouse. Let's dim it back a little bit, make it gray. There we go. So that could be a potential hang-up level, but generally speaking, on the daily time frame chart, right, if this is a double bottom over the neckline, it's also technically a look below and fail on the range. The target should be the top end, which is 340 here. So with respect to 320.15 we just popped in, generally speaking, ideas would brew along these lines like this. If you could get it long here, right, you have risk, reward to the top of the range. Let's try that again. Risk, reward. If you get the Brigade bolt here, then typically you have risk, reward. So the expected value of this opportunity is higher than this one, but you're probably dealing with better confidence at that point if you're over 301, right? So that is that out of Coinbase. That is your first trade idea. And your second and final is on TTD, right? One on the short side. So this is not played out all the way. I'm not saying it's in play like tomorrow directly. However, we can start to see, right, how this is clearly suggesting left head, maybe a right shoulder here, but even further than that, right? Think about what the broad market did today. The broad market was quite strong, right, on the gap up, and it held the gap up. It did not fade the gap at all. But what did TTD do? First of all, it didn't even gap up. Second of all, in the upper wick, it rejects the previous day's high and the 50 SMA. And then third of all, it sweeps the low and closes extremely weak on the lows of today's session. I mean, this is down like 3.06% from the prior day's close. It's very close to the opening print as well. So really weak looking here out of TTD. And if it breaks this, right, I think it's game on looking for shorts under 116.15. And again, what's the caveat? Well, like Google, I would say you would want to make sure that the broad market is also bearish. If the broad market is pulling back, then we'll watch TTD. If the broad market is strong, then I would say, hey, let's watch Coinbase. Right? And let's forget about TTD. Let's watch Coinbase if the broad market's strong. Let's watch Amazon continuing to the upside. Let's watch NVIDIA for the higher low over 140, right? So anyhow, those are the ideas I have for you in today's episode of the Midweek Market Update. If you enjoyed the episode or learned something new, let me know down below in the comments section or by giving the video a very simple thumbs up. Appreciate you all coming out to the show. We'll see you tomorrow morning in the pre-market prep live every morning, 8 o'clock Eastern time, here on the channel. As long as the market's open, we are live. We'll give you the game plan for the day and set you up with a couple of trade ideas, and then it's up to you to execute those. But we'll see you there. Have a green trading week, and I'll catch you in the next one.